Hey, good evening, everybody. Thank you for joining me here on the podcast on this, I guess it's not a weekend edition because today's Friday, but it's the weekday. No, it's the week wrap-up. That's what this is. This is the wrap-up show. Everybody's got to name stuff, right? This is the wrap-up show for the week that ended August 9th, 2013. The S&P down 6 points this afternoon, back below 1,700. It's at 1,691. The Dow Jones, 15,425. It was down 73 on the day. And the NASDAQ was down 9 points to 3660. Interest rates were down a little bit today. The volatility index was up on the day. And mid and small caps outperformed on the day. So we'll get into all of that in just a minute. You can see a picture of the S&P, kind of weak throughout the day. Had a little bit of a bounce back as we've been seeing a lot of these days where it sells off and it tends to come back towards the end of the day and just kind of drifted lower for most of the day there. Okay, so here's the picture that we have been looking at for a while now, and really not a big change. The only thing I would draw your attention to is the fact that we kind of have broken out of this uptrend once again as we did here, and but I think bigger than that is the sideways action that you're getting. You know, any gains from yesterday were erased today. You know, the Dow was down 130, 140 earlier in the day, and only finished down 73, but still we're coasting. And what I see by looking into the internals and looking at what's going on as far as some of the risk indicators that we look at and the oscillators is that right now what you're seeing is the demand for stocks, the demand that has pushed us up this year, and the demand that has pushed us up in the last month or so. This has evaporated. And now there's a difference between the demand evaporating and the selling picking up. Remember, when we see demand going down and we see selling picking up, that is when you have to be worried that something bigger is happening. And what we're seeing right now is only half of the equation. We're seeing demand drop off. It's not being met with a lot of selling though. So you have people that are wanting. They were really, dying to get stocks, and now they're just saying, I'm okay holding my position. But they're not liquidating those positions. That's not happening right now. And so what you're ended up getting is this sideways drifting pattern, where it's just up and down and up and down. And again, if you look at these Bollinger Bands here, which were really wide back in late July, are really, really tight now. So pretty soon, and I don't know how long it will be, but pretty soon we're going to break out one way or the other. Now you could have figured that out without my help, because the Bollinger Bands, they do tell you that, but knowing that this has been moving sideways for a while, obviously the next statement is that it's going to break out one way or the other at some point. So not giving you a lot of insight there, but I guess what you really want to know is if it's going to be this way or that way, and I don't have that crystal ball. But I would say that I think we're very it's setting up for potentially a move down temporarily. And I don't think it'll be a whoosh down that is, something that would cause us to change overall strategy or anything. But I do think that we're setting ourselves up for a move to at least test, potentially the 50-day moving average, and then of course potentially even the 100-day moving average. And again, that would be right in line with with what we'd seen in the past. But we have been in a really, really tight range. I posted something on Twitter today, at Karl Eggers is the handle, and I was showing a 5-minute picture over the last, really going back for most of this week, and we've been less than a 1% range this whole week. So we've been very, very tight, bouncing back and forth. So we'll break out, and I don't know what the what the reason would be for that. But at some point that will happen. But what you are seeing is you're not seeing the rotation necessarily from stocks to bonds, although interest rates have peaked for now, it looks like, at least for a while, because, again, we pointed this out last podcast, but you've had interest rates top here and they've topped here, but they're not going down. They're doing just like the stock market. They're being just as stubborn on the upside or downside as stocks are. So they're not rolling over just yet and heading down like this. They're just moving sideways. So you've kind of got this balancing act where the sellers and buyers are perfectly even on stocks and they're perfectly even on bonds. But what you are seeing the rotation to out of stocks in the short term, I think, a little bit, is you're seeing the money not come out of the market, but you're seeing a little rotation within the stock market. And where I want to draw your attention to is coal. Coal stocks have been something that this is the first time, and people calculate moving averages differently, but based on what I'm looking at, this is the first time coal stocks have been above their 50-day moving average since, we're going way back to February of this year. So that's kind of a big deal. You're also seeing stocks like the gold miners kind of getting perky. They had a huge day yesterday. The junior miners were up 9% yesterday, and you would have thought they would have given some back today, and they didn't. But we're at a critical point kind of in this area where not only this, but gold itself is going to work its way potentially higher to test this once again. And remember, it failed a few days ago, right? It was rallying up, and it failed right at this 50-day moving average, and it's sitting right on it right now. So, again, the bulls need to see this get broken above, come down and test it, and then head up. And we'll see. Somebody on Twitter was basically saying he thinks he's very, very bullish on gold, and nobody really understands what gold is. And I told him, perhaps you're right, but we need to see the 50-day moving average. It needs to go above that first, because that's something that's been a line in the sand. And he said, well, some people use technicals. I use feel, and I just hope he didn't feel that gold was, a bargain back over here or here or here. Okay, so I understand feel, but I think if you would talk to anybody that has been on Wall Street for a while, or managed money, or traded, or had any investments, feel's usually the thing that gets you into trouble, actually. It's not the thing that works. So I'm not criticizing. It may be working for him, but I wouldn't suggest everybody else listening to this use feelings, because feelings are typically the best contrarian indicator out there. And so what we're seeing in gold is we're seeing some strength in the last couple of days. And I don't know if it's, you saw some mixed data out of China. The market took it as positive. But what you've noticed is since that happened, some of these material stocks, if you look at XLB, the materials ETF, that is approaching this new high here. And so that's been actually strong the last couple of days. It was up almost 0.6% today when the Dow was down 0.5%. So we're seeing some outperformance from some of these, we'll call them, emerging market type of trades. It reminds me of the '06 global growth trade. That's what you've seen the last 24, 48 hours. Those types of things are working. And I don't know if they'll continue. They can't continue if global growth doesn't pick up. But you're seeing that rotation within stocks right now. And, you've been seeing things like financials the last few days pull back. So the things that were leading are starting to lagging. The things that were lagging are starting to lead. By the way, Exxon had its, I think it was a 9-day losing streak. It's lost money, or I think it was 11 days in a row it lost money. So 12 out of the last 13 days, it has lost money. And this streak here of 11 days, I think, was its longest in over a decade or something crazy. And then, remember, this is after it broke out. This is something I've been watching very closely, because you change this to a weekly picture on Exxon, and what you'll see is going back to '08, it had just gone above the old highs of '08, but it didn't confirm it. It didn't stay above it. So now, is it in danger of breaking this uptrend it's been in? And if it does, then you could see much lower prices. So watching Exxon, because I think that's really interesting. You would have hoped this would have broken out and come back and then bounced off that and shot up higher. I think Walmart and some others have done that. Also, if you take a look at IBM, this is becoming an interesting picture. This is at a 52-week low right now, or at least it was, I think, earlier in the day. So very close to it's a closing. I think it's a closing 52-week low. So IBM, which has been the kind of the stalwart the last, since the recovery in '09, kind of has this rounding effect to it, doesn't it? Kind of looks like the thing is starting to roll over a bit. So let's watch that. This is heading up. Then the angle's a little less severe. Then it's flat. Then is it starting to roll over? And so let's watch that. I mean, this is, by the way, this is how bull markets become bear markets in microcosm. Now, I'm not pointing to IBM and saying what they do leads the market. Obviously, they're a big stock, $200 stock, so they have a heavy weighting in the Dow Jones as its points weighted. But this is, if you were to look at how bull markets end, this is how it happens, is that they burst up, and then things just start to slow. The intensity slows down. Okay, whereas bear markets are going down, people are panicking, and then it just turns back around and heads back up. That's what this V that you're seeing here. This V is what bull markets starting look like. Bull markets that end, they don't go up and then just turn over and head down. That's just very rare that happens. And so overall, when we look at the overall market, we can always be starting a bear market at any time, but I can tell you that we don't see any signs of it just yet. And it's looking at things like looking at how many stocks are going up versus down, looking at which sectors are participating in the rally, which ones aren't. But you are seeing some warning signs in the short run. A lot of people like to look at things like junk bonds, and you look at junk bonds, and you notice that they peaked, back here in May, and they've been making lower highs. Okay, and if you go back to 2011, they did the same thing before we had that really nasty 22% sell-off in the S&P. So you got to be careful here because, again, I think people, and we pointed out the VIX, have been letting their guard down in this market because had you just, bought some mutual funds, you would have been fine. And now, granted, they had to be U.S. stocks. U.S. stocks are the one thing that have made money this year. Most everything across the spectrum has lost money, from gold to emerging market bonds to high-yield bonds. A lot of things have lost money. Tips, even the safer things have lost money, but U.S. stocks have been the one saving grace. But, we do have some complacency now. And it's because, as an American, and most of you are American listening to this, not all of you, but most of you are, you probably own a lot of American stuff, American investments. And so you're luckily positioned the right way, right? Imagine if you're somebody that's a Spaniard, and you probably own a lot of European stocks, and for a while that was really scary. Now they're starting to outperform the U.S., but that's another story. Imagine owning just Chinese stocks. So those are things that you have to look at from a big global perspective. But we do have some complacency. But what you're seeing now is things like IBM, rolling over and heading down. You're seeing some of the home builders, right? This is clearly looks broken, and there's a lot of people who I'm sure are going to be, as this rallies, shorting it. But it's at a point right now where if it breaks this, and I mean it's sitting right on it, and we'll zoom in here as soon as I draw this. We're sitting on this lows going back. If it breaks this thing is going to get nasty. You've already seen this. It's really close to this, these death cross, they call it, where the 50-day moving average, which is the blue line, crosses the 200-day moving average, which is the red line. Very, very close to doing that. So you got to watch some of that stuff. So some of these things that were leaders are starting to fade a little bit, but can they be made up with different leadership? What if the coal stocks started rallying, the material stocks continued, and the gold stocks? They're stocks, and so what if it's just a different type of stock leading this rally? But that's what we need to watch for, is the peeling off of layers of leadership going away and turning into laggards. And that would be one thing that would cause us to get concerned about the stock market. Right now, we look like we're just set up for potentially a temporary sell-off. It's as if the market's stalling out. It's sputtering. It's like an old Studebaker. It's missing a little bit. And so when it all it takes is somebody to tip it over, right? A little bit of selling picking up would cause us to sell off, a little faster. But again, I think ultimately that's probably going to be a buying opportunity, because I don't see the long-term worry signs just yet. And they can always start, but I don't see them as of right now. By the way, take a look at this. This is a chart I made. You can see that this is a ratio of European stocks versus the S&P 500. So most of 2013, by it going this way, it's telling you that U.S. is outperforming Europe. And in early July, that changed, and it started going up. Now, we've had little pieces here that have happened like that, but now we've broken this downtrend that's been in place for most of 13. So European stocks are now outperforming U.S. stocks and have continued. So that may surprise some of you, because we talk about the problems going on in Europe. But again, there's good parts of Europe and there's bad parts of Europe. And there's some European stocks that are ultra cheap. And I know a lot of people betting on those companies, because they look at the U.S. stocks and they say, yeah, they're good, but they've made their run. These European stocks, they're not just they're being taken down because of Europe, but they may be selling their products all over the world, not just to Europeans, and so and maybe to some good parts of Europe. But basically, they're outperforming right now, and and I'm not suggesting to run out and buy IEV, which is the European ETF, but I'm pointing this out that there's been a little rotation, and that's something we need to watch as well. ECRI data, remember they're the Economic Cycle Research Institute. They're the ones that have been calling for a recession the last 2 years. Still believe we're in a recession, but their data seems to be conflicting with what they're saying. This isn't the latest data. This is through last week, but you can see this is their growth level. This is their index, and you can see it's basically all pointing up, and it's going up. And in fact, just today, which isn't reflected in this, their leading indicator went up to a 131.8, and that's the highest level since May of 2010. So again, it's kind of conflicting with what they're saying, but this is part of what's going on. Why the stock market continues to rise is this data overall. When you put everything in the blender, it's coming out a little better than perhaps what people thought. But I will say, if you look at what's caused this rally, a lot of this has been multiple expansion. What that means is PE levels are rising. So people are paying for $1 of earnings. They're paying more for it than they did 6 months ago. So, there's really what drives stocks. It's profits, it's earnings, it's dividends, and then how much people are willing to pay for that. And earnings growth hasn't made up a big portion of this. In fact, if you look back at if we go back to just after the crisis of 2008, in 2009 and 2010, during these periods here, and maybe even part of 11, a lot of this was because the profits were rebounding. They were going up a lot, yet people didn't believe it because they were still scared from the crisis. And so what happened was PEs were actually shrinking during this time. Stocks were becoming cheaper, even though they were going up. But in the last couple of years, you've seen just the opposite. Earnings aren't going up that fast, yet you're seeing people pay more for them because they're becoming more confident, and dividends are a small portion, but it's because of multiple expansion. So, just to let you know what's causing this to go up, it's not that things are so much better. It's people are paying more for the same amount of earnings than they were, back even a couple of years ago. So as usual, next week we're going to have a lot of data coming out. Sunday night, Japan's going to come out. I think their GDP numbers, and then Europe's going to be Wednesday. We're going to have more earnings. I think Cisco may be coming out. And then, later this month, I think the 22nd of August, Jackson Hole, it's when all the economists get together. It's a wild and crazy time with the economists getting together, but they'll be doing that. It's a beautiful place from what I hear. But anyways, so that's coming up. So you got a lot of economic stuff coming out next week. But for now, this tug of war is perfectly at this stalemate at 1,700 or so, 1,691 to be precise on the S&P 500, and the Dow Jones sitting at 15,425. Looks a little worse actually than the S&P. Kind of looks like it is already started to kind of roll over. And then we look at things like the Russell, which had been leading the Russell 2000 small companies. They kind of look more like the S&P, just moving sideways. And mid-cap stocks kind of have a little upward bias to them, but they are also moving sideways as well. So right now, kind of a stalemate, and really the only things working a lot today were REITs and oil stocks, energy, gold stocks, and some oil and gas stocks were working, and some treasury bonds. Those were mainly what was working today, but overall, the stock market has been pretty sour the last few days. So don't get complacent, and continue to use your strategies, because things can change very, very quickly. Hey guys, have a wonderful weekend. Don't forget to direct your questions to Karl at eggerscapital.com, and Google+, Facebook, all those types of things. Retweet them, reshare them, repost them, refriend them. I don't know what they call it, but do all that other stuff that spreads the word. All right, have a great weekend. We'll talk to you soon.